Hello everyone, my name is Mathew, and in this video I will be demonstrating discounted cash flow or DCF modeling using Excel. As you can see on the screen, I have opened a structured financial model. This sheet contains both historical data and projected financials for the company. If you look at the bottom, we have different tabs like historical financials, and this one like free cash flow. Then we have WACC, terminal value, discounting, and final valuation in a different Excel. So this Excel model is structured step by step to complete the entire DCF valuation process. Okay, if you look on the screen, on the left side, we have historical performance such as revenue, operating profit, net profit, and other financial metrics across the multiple years. On the right, we have projected values where we forecast how the company is expected to perform in the future based on certain assumptions. Now, before going further, let's understand what DCF modeling actually means. DCF, or discounted cash flow, is a method used to estimate the intrinsic value of a company or a business based on the future cash it can generate. The basic idea is simple. A business is worth the present value of all future cash flows. So in this model, we will first calculate free cash flow, then determine the discount rate using WACC, estimate the terminal value, discount all cash flows, and finally arrive at the value of the company. Now I'll move to the free cash flow sheet. Here, as you can see, we have an assumption section which includes EBIT, tax rates, depreciation, amortization, capital expenditure, and working capital changes. These inputs are used to calculate free cash flow. Now I'll explain it step by step. First, we start with the EBIT, which represents operating profit. Then we calculate tax by multiplying EBIT with the tax rates. Since tax is cash outflow, it will be negative. We'll make it as negative. Now we add back depreciation and amortization. These are non-cash expenses. So although they reduce profit, they do not reduce actual cash. Then we subtract capital expenditure because it represents actual cash spent on asset. After that, we adjust for working capital changes, which also impact cash availability. And finally, we use the sum formula to combine all values. Sum formula to combine all values. And this gives us free cash flow. So effectively, we are converting accounting profit into real cash flow available to investors. As we can see, the free cash flow comes out to 86, which represent the actual cash generated after all expenses and reinvestments. Now let's move to the WACC calculation. So WACC stands for weighted average cost of capital, and it represents the required return expected by both equity investors and debt holders. A company raises capital through equity and debt, and each has a cost. Cost of debt is simply the interest paid on borrowings. Cost of equity is calculated using the CAPM model. The formula is risk-free rate plus beta multiplied by market return minus risk-free rate. Now in the sheet we are given input like equity value, debt value, cost of debt, tax rate, beta and market return. First I'll calculate cost of equity using the CAPM formula. Then I calculate the proportion of equity and debt in total capital. After that I apply the WACC formula. Equity weight multiplied by cost of equity plus debt weighted multiplied by the cost of debt adjusted for tax. This gives us the WACC value. In this case, WACC comes out to around 6.9%. This will be used as a discount rate to bring future cash flow to present value. So right now I will show you the calculation here. As you can see, so as you can see, its cost of equity is around 10%. Now we will calculate the WACC. As we can see the formula. So now let's move to one of the most important parts of DCF modeling, which is terminal value. As you can see on the screen, we have a separate section for terminal value calculation along with assumptions like WACC, growth rate and EBITDA multiple. Now the reason terminal value is required is because we cannot forecast cash flows indefinitely. Typically we forecast for about 5 to 10 years, but a company continues to operate beyond that period. So we need a way to estimate the value of all future cash flows beyond our forecast horizon. This is what we all call terminal value, and in most DCF models, this actually contributes a significant portion of the total valuation. Now there are two commonly used methods. The first method is the perpetuity growth method. Here we assume that the company continues to grow at a constant rate forever. So what I'm doing here is taking the final year free cash flow and multiplying it by 1 plus the growth rate. As you can see the formula in this screen. Now this growth rate should be realistic. Typically we take it close to long-term GDP growth or industry growth rate, because a company cannot grow faster than the economy forever. Then I divide this by the WACC minus the growth rate. This denominator is very important because it represents the required return adjusted for long-term growth. Now this gives me the terminal value using the perpetuity growth method. As you can see here, 984. Now the second method is the exit multiple method. That I'll be just giving a brief now. Here instead of assuming infinite growth, we assume the company will be valued based on the market multiples. So what I'm doing is taking EBITDA and multiplying it with a chosen multiple. This multiple is usually based on comparable companies or industry benchmarks. So for example, if similar companies are trading at 7 times EBITDA, we use that as our multiple. Now I'll calculate this value as well. Now at this point we have two different terminal values. In practice, analysts either choose the most appropriate method or take an average to balance both approaches. As you can see here, I am taking the average of both values, get a stable estimate. Now one more important point to understand here is the terminal value is highly sensitive to assumptions. Even a small change in growth rate or WACC can significantly impact the valuation. So while building models, we have to be very careful with these inputs. Now we move to the core of this concept of DCF, which is discounting. As you can see on the screen, we have the discounting section, which we convert future cash flows into present value. Now the basic idea here is the time value of money. Money today is more valuable than making or valuable than money in the future because of factors like inflation, risk, and opportunity cost. So we cannot directly compare future cash flows with the future or today's value. We need to discount them. Now the formula we are using here is, as you can see here, 1 divided by 1 plus WACC raised to the power of time, that is n. So here WACC acts as the discount rate. Now in Excel, what I am doing is applying this formula and locking the WACC value using absolute reference. This is important because when I drag the formula across multiple years, the WACC remain constant while the time period changes. Now once I have the discount factors, I multiply each year's free cash flow with the corresponding discount factor. So I'll just drag it like that. So this gives me the present value of each year's cash flow. Then I also discount the terminal value using the same method. So now finally I take the sum of all these present values, So I add present value of all future free cash flows, present value of terminal value, and this gives me the enterprise value of the company. So it is the PV of terminal value, and this gives me the enterprise value of the company. Here you can see, now that we have the enterprise value, the next step is to calculate equity value. Now enterprise value represents the total value of the business, including both debt and equity. But as investors, we are interested in the value available to the equity shareholders. So to convert enterprise value and equity value, we adjust the debt and cash. The formula is equity value is equal to enterprise value plus cash minus debt. So in this Excel, what I'm doing is I take the enterprise value, I add cash and marketable securities, and then I subtract short-term and long-term debt. This gives me the equity value. Now the final step is to calculate the share price. For this, I divide equity value by the number of outstanding shares. This gives me the intrinsic value per share, that is of 8.33, as you can see here. Now comes the most important part of the entire DCF model, which is interpretation of the results. Up to this point, we have built the model, applied formulas, calculated the values, but the real value of financial modeling lies in understanding what these numbers actually mean. So if you take the step 1, what does intrinsic value represent? Now the value that we have calculated here is called the intrinsic value of the company. This represents the true worth of the business based on its ability to generate cash in the future. So this is not influenced by the market sentiment or speculation or short-term movements. It is purely based on the fundamentals. Now in order to make this useful, we compare this intrinsic value with the current market price. This comparison is what helps investors make the decision. Now let's understand this clearly with scenarios. Take the scenario 1 as overvalued stock. If the current market price is higher than the intrinsic value that we calculated, it means the stock is overvalued. For example, if the market price is 10 and our calculated value is right now 8.3, this means investors are paying more than what the company is actually worth. Now, why does this happen? This happens due to multiple reasons. Maybe market hype, over-optimistic speculations, speculative buying, or short-term news. In such cases, as a rational investors, we should avoid buying the stock at that price. Because even if the company performs well, the price may correct over time. Now let's take the opposite case. Suppose it is overvalued stock. If the intrinsic value is higher than the market price, it means the stock is undervalued. For example, if the market price is 7 and our calculated value is 8.3, this means the stock is available at a discount. This is where investment opportunities exist. Because over time, if the market corrects by itself, the price may move towards its intrinsic value. So this is where investors typically look to buy. But one important concept here is margin of safety. Even if a stock is undervalued, investors usually don't buy it immediately. They look for a sufficient gap between intrinsic value and market price. This gap provides a cushion against errors in assumptions or unexpected risk. So instead of buying at 8 when value is 8.3, an investor might prefer buying at 6 or 7 to reduce the risk. Step 5 is like link back to assumptions. Now it is very important to understand that the entire valuation depends on assumptions. If we change the growth rate or WACC or margin, even slightly, the final value will change significantly. So this model is not giving an exact answer, it is giving an estimated range of value. Then thinking about the sensitivity, for example, if I increase the growth rate slightly, the valuation increases. If I increase the WACC, which represent risk, the valuation decreases. So the model is highly sensitive to key inputs. That is why analysts often perform sensitivity analysis to understand how different scenarios impact valuations. In real world finance, DCF is not used in isolation. It is combined with market multiples, industry analysis, qualitative factors, because valuation is both an art and a science. Numbers give us directions, but judgment plays a key role. Decision making. So based on this model, an investor can take more informed decisions instead of blindly following the market. They can evaluate whether a stock is worth buying or not. This helps in avoiding overpaying, identifying undervalued opportunities, and making rational investment decisions. So if I will conclude over here, so it's like, so overall this interpretation steps connects all the calculations to real world application. Without this step, the model is just numbers. With interpretation, it becomes a decision making tool. So let's come to the conclusion, and in this session we have built a complete discounted cash flows model step by step using Excel. We started by understanding the structure of the model and the historical financial data. Then we moved to the calculating free cash flows, which represent the actual cash generated by the business after all expenses and investments. After that, we calculated WACC, which is discounted rate that reflects the required return for both equity and debt investors. We then estimated the terminal value to capture the value of the business beyond the forecast period using both perpetuity growth method and as well as the exit multiple method. Next, we discounted all future cash flows to present value using the time value of money concept. From that, we derived the enterprise value of the company. Finally, we calculated equity value and arrived at the intrinsic share price, which helps us determine whether a stock is overvalued or undervalued. So DCF helps us make decisions based on fundamentals rather than market noise. However, it is also important to remember that the model is only as good as the assumptions we use. So it should always be combined with judgment and further analysis. Overall, this approach gives a structured and logical way to evaluate a company and make informed investment decisions. Thank you.